Electric vehicles are struggling to sell big time. Rivian and Lucid Motors just reported earnings for the fourth quarter of 2023, and it's safe to say that the outlook for 2024 is looking very grim. Although Rivian beat forecasts for revenue in the fourth quarter at around $1.36 billion, it cut its annual production guidance for the full year 2024 from 80,000 units down to 57,000. That is obviously a huge cut that seems extremely abnormal for somebody as big as Rivian, especially with the backing they've had over the past few years in ramping up their sales. But as it turns out, in the midst of a global supply chain crisis, as well as record high interest rates, this kind of forecast is actually much harder to make for a startup than any other company in this industry. And that also has partly to do with the fact that buyers are slowing their adoption of electric vehicles aggressively over the past 4 to 6 months. Lucid themselves just reported earnings of around $157 million in the fourth quarter in the form of revenue. And similar to Rivian, they cut their forecast for the 2024 year from 90,000 that they predicted at their SPAC IPO down to just 9,000, which essentially leaves both companies with a flat growth rate from 23 to 24. Having flat growth in the EV industry is an extremely poor performance, and growth is what investors and Wall Street is at the end of the day paying for. But as it turns out, folks, 2024 is going to be a unique year. Investors and even customers are not going to be paying for growth anymore. Instead, investors are going to be paying for variety instead of volume going forward. The issue with the EV industry right now, folks, is twofold. Not only are record high interest rates that we haven't seen in almost 25 years driving down the prices of electric cars and gas-powered cars at record levels, but all of a sudden, buyers for EVs are shifting from the early adopters who have plenty of discretionary income left remaining to the pragmatic buyer who wants to commute to work from point A to point B 5 days a week. These two headwinds are coming together at a very poor time for the auto industry, which is exactly why a startup like Rivian or even Lucid Motors is going to be struggling to forecast any meaningful growth over the next 12 months. The market landscape is shifting so quickly with the CPI inflation data that we just saw last month, which shocked markets across the country, that startups have no way of predicting how well the consumer is going to behave, given the uncertainty provided by even the government itself. Not to mention the fact that most of the electric vehicles out on the market right now, a majority of them, are actually very expensive, apart from the likes of the Tesla Model 3 or the Tesla Model Y. The average selling price for a car in the United States is just around $48,000, both including the new and the used market. And that data is heavily skewed towards expensive vehicles. And as you can see, those people are exactly the folks that are starting to pull back on their adoption, with leaving automakers with nothing but dealership lots that are fuller than what they were 12 months ago, and them having to cut prices on their overly inflated vehicles. We aren't seeing a complete collapse in the EV industry, where sales are going below the levels we saw quarterly in the 2022 and 2021s, but still a slower growth than anticipated by the heavily optimistic investors of these companies' IPOs. And as you can see, this trend is in line with what the overall industry is also experiencing, with growth going down from around 76% to just 42% year over year in November 2023. We are essentially seeing a correction in the fast-paced growth for electric sales coming back down to the mean following the boom of the pandemic. And in my opinion, the only way to avoid this spiraling down towards the negative territory is by launching cheaper and more variety of electric vehicles. Interest rates are at all-time highs, and people who want to buy vehicles in the $50,000 range don't have a lot of options, especially given the challenges of infrastructure for those that don't have a garage to charge their vehicle at overnight. Now, in no way, shape, or form is this the end of the electric vehicle boom that was propelled by the coronavirus pandemic, because right now, EV adoption is still just 1.2% of the total penetration we're seeing across the United States, with over 276 million cars sold and just 1.2% of them being registered as EVs or plug-in hybrids. The market is clearly still huge, and the opportunity for growth is immense. The only thing we're seeing is a slight speed bump in the short term, driven by macroeconomic factors that are basically out of the control of most electric vehicle companies. Innovation, product variety, as well as bringing in lower cost vehicle to the market is going to be the medicine to the sickness the EV market's experiencing in the short term, and I'll be excited to see how that plays out in 2024. But as usual, folks, thanks a lot for watching, and I'll catch you guys in the next one. Take care.